So, Amazon just dropped their latest earnings report, and at first glance, the numbers look absolutely spectacular. But if you dig a little deeper, an analysis from BGVC reveals a completely different story, one that's all about redefining the entire future of the company. Let's get into it. So here it is, the central puzzle of this whole report. Record-breaking revenue on one hand, but on the other, the actual cash the business generated, it plummeted by over 70%. How in the world does that happen? What is really going on inside Amazon right now?
Okay, so first up, let's talk about the good news, the shiny, surface-level numbers that got Wall Street all excited. And believe me, these numbers are huge.
Get this. In just a fourth quarter of 2025, Amazon raked in $213.4 billion in net sales. That's not just a record, it totally smashed what the market was expecting.
That's a 14% jump year over year for the quarter. Now, you got to remember, in an economy like this, for a company of Amazon's size to be growing that fast, that is seriously impressive.
And what about the whole year? A jaw-dropping $716.9 billion. It really looks like this growth machine is just completely unstoppable.
And this table here, it really lays out the big picture perfectly. Look at it. Net sales, up. Operating profit, up. Net profit, up over 30%. I mean, everything looks absolutely fantastic until you get to that very last line, free cash flow. This is the actual cash the company has left after paying its bills. And it didn't just go down a little bit, it fell off a cliff. And that one number right there, that's the key to unlocking Amazon's entire strategy right now.
All right, so we've seen the highlight reel. Now it's time to peel back the curtain and look at the cracks forming underneath. Because the real story about Amazon's profit, well, it's way more complicated and honestly, way more interesting than the headlines are telling you.
Yeah, that's right. A drop of 70.7%. That is the collapse we're talking about in their annual free cash flow. Think about it. The company went from having over $38 billion in cash to just $11 billion. So the big question is, where on earth did all that money go?
Well, for one thing, the company took some pretty big one-time hits in Q4. You've got over $1 billion to settle a tax thing in Italy, another $730 million for severance packages, and they wrote off more than $500 million in physical store assets. You add all that up, that's almost $2.5 billion in one-off costs just hitting the books all at once. And then there's this, that huge $77 billion net profit. It's a little misleading. See, almost 10 times billion of that wasn't actual cash from selling products or services. Nope, it was a paper gain, an on-paper valuation increase from their investment in the AI company Anthropic. It looks great on an income statement, sure, but it's not cash they can actually go out and spend.
And then there's the third piece of the puzzle, and this is where it gets really interesting. They made a major accounting change. They decided to shorten the official useful life of their servers from 6 years back down to 5. Now, why in the world would a company do that?
The answer is AI. It's because the relentless, blistering pace of AI development is making their hardware obsolete way faster than they ever planned for. This is basically Amazon admitting, right there in their accounting, that the speed of tech change is now so fast it's forcing them to rewrite their own financial rulebook. That's a huge deal. So you've got profits getting squeezed by all these charges, you've got cash flow taking a nosedive. How can Amazon possibly afford to make this massive strategic pivot? Well, the answer lies in two incredibly powerful profit engines humming away inside the company. First up, you've got Amazon Web Services, AWS. After a bit of a slowdown, it is absolutely roaring back. Q4 growth hit 24%. That's a 13-quarter high, and it's pretty much all being driven by companies scrambling to build on top of AI. And listen, this isn't just some one-time blip. AWS is currently sitting on an order backlog of $244 billion. That's almost $250 billion in future revenue that customers have already committed to. That provides an incredible amount of financial stability.
And this chart here really puts it all into perspective. Yeah, online stores are the biggest piece of the pie by revenue, but look over here at AWS and advertising. Together, they're nearly 28% of revenue. But here's the kicker. Their profit margins are so ridiculously high, they basically act as the financial engines that power everything else Amazon does.
And that brings us to the absolute core of this whole thing, the central thesis of this entire analysis. All of this financial weirdness, the confusing profits, the crashing cash flow, the accounting changes, it all points back to one single thing, a massive company redefining bet on the future of AI. Okay, get ready for this. Here is the number that will define Amazon's future. For 2026, their guidance for capital expenditures is $200 billion. No, that is not a typo. $200 billion. This isn't just an investment, people. This is a declaration of war for who will dominate the future of AI.
So, where is a couple $100 billion going to go? Well, it's basically a three-pronged attack. First, a gigantic build-out of data centers specifically for AI. Second, their super ambitious Project Cooper satellite internet network. And third, rolling out a whole new generation of advanced robotics in their fulfillment centers.
Now, to make a bet this enormous, even remotely possible, they can't just keep writing massive checks to NVIDIA for their expensive chips. It's not sustainable. So what do? They're pouring money into designing their own custom AI chips, like Trainium. The goal here is simple: control your own destiny. And most importantly, control your own costs.
So when you put it all together, what Amazon's management is doing is sending a crystal clear message to investors. They're basically saying, hey, stop looking at this quarter's profit. That's not the game we're playing. Judge us on our long-term return on invested capital. Judge us on how efficiently we can turn these mind-boggling investments into real profit years down the road. It's a total pivot from chasing short-term gains to cementing long-term dominance.
And so that leaves us with the billion-dollar question. Well, the $200 billion question, really, hanging over one of the world's biggest companies. Is this enormous bet on AI a brilliant, visionary move that's going to secure their dominance for the next decade? Or is it a boulder so big, so heavy, and so expensive that it ends up crushing the very cash flow the company needs to survive? I guess we're all about to find out.